Inventory fundamentals. Inventory is a total of tangible personal property held for sale in the ordinary course of business in the form of work in progress to be completed and sold in the ordinary course of business or to be used up currently in producing goods or services for sale. Inventory does not include long-term assets subject to depreciation. Financial statements presentation. Inventories are generally classified as current assets in the financial statements. They are expected to be realized in cash or sold or consumed during the normal operating cycle of the business. Inventory accounts. The inventory of a retailer trading entity consists of goods purchased to be resold without substantial modification. The inventories of a manufacturer consist of goods to be consumed in production materials, goods in the process of production, work in progress, and the finished goods. Cost basis of inventory. Initial measurement. The cost of inventory includes all costs incurred in bringing the inventories to their existing location and ready-to-use condition. The cost of purchase inventories include the price paid or consideration given to acquire the inventory, net of trade discounts, rebates, and other similar items, import duties and other unrecoverable taxes, handling, insurance, freight-in, and other costs directly attributable to acquiring finished goods and materials, bringing them to their present location and conditions, sellable or unusable condition. Inventory accounting systems. A perpetual inventory system updates inventory accounts after each purchase or sale. This system is generally more suitable for entities that sell relatively expensive and heterogeneous items and requires continuous monitoring of inventory and cost of goods sold accounts. Under this system, inventory and cost of goods sold are adjusted as sales occur. An advantage of the perpetual inventory system is that the amount of inventory on hand and the cost of goods sold can be determined at any time. A disadvantage of the perpetual inventory system is that the bookkeeping is more complex and expensive. In the periodic inventory system, inventory and cost of goods sold are updated at specific intervals, such as quarterly or annually, based on the results of the physical count. Bookkeeping is simpler under this system. That is generally used by entities with relatively inexpensive and homogeneous items that have no need to continuously monitor the inventory and cost of goods sold. Under the periodic system, changes of inventory and cost of goods sold are recorded only at the end of the period based on the physical count. Inventory period ending physical count. An annual period and inventory physical count is necessary under both the perpetual and periodic inventory accounting systems. The amount of inventory reported in the annual financial statements should be based on a physical count. Under the perpetual system, a physical count helps to detect misstatements in the records and thefts of inventory. Under the periodic system, the amounts of inventory and cost of goods sold can be determined based only on the results of a physical count. For a physical count to be accurate, the entity must count all items considered to be inventory and eliminate all items that are not. Items to be counted as inventory include the following: goods in transit. Items in transit are inventories that on the physical count date are not on the entity's premises and are on the way to the designated location and whose legal title is held by the entity. The entity bears the risk of loss on inventory in transit. The following are the most common shipping terms: FOB shipping port, legal title and risk of loss passed to the buyer when the seller delivers the goods to the courier. The buyer must include the goods in inventory during shipping. FOB destination. Legal title and risks of loss pass to the buyer when the seller delivers the goods to a specified destination. The seller must include the goods in inventory during shipping. Goods out on consignment. A consignment sale is an arrangement between the owner of goods, consignor, and the sales agent, consignee. Consigned goods are not sold, but rather transferred to an agent for possible sale. The consignor records sale only when the goods are sold to the third parties by the consignee. Goods out on consignment are included in the consignor's inventory at cost. Costs of transporting goods to the consignee are inventoriable costs, not selling expenses. The consignee never records the consigned goods as an asset. Inventory errors. Inventory errors impact many elements of the entity's financial statements. Affected elements of the balance sheet include current assets, working capital. Working capital equals current assets minus current liabilities, and ending stocks equity. Affected elements of the income statement include cost of goods sold and net income. A common error is inappropriate timing of the recognition of transactions. If a purchase on account is not recorded and the goods are not included in ending inventory, cost of goods sold and net income are unaffected. Current assets and current liabilities are understated. If purchases and beginning inventory are properly recorded, but items are excluded from ending inventory, cost of goods sold is overstated. Net income, inventory, retained earnings, and working capital are understated. Errors rising from transactions recorded in the wrong period may reverse in the subsequent period. If any inventory is overstated, the overstatement of net income will be offset with the understatement in the following year that results from the overstatement of beginning inventory. Inventory. Yes, specific identification methods. A specific identification requires determining which specific items are sold and therefore reflects the actual physical flow of goods. This system is appropriate for items that are not ordinarily interchangeable, items that are segregated for a specific project, blocks of investment securities, or special inventory items, such as automobiles or heavy equipment. Any item that has a serial number on it is a candidate for the specific identification method. Specific identification is the most accurate method because it identifies each item of inventory. However, it requires detailed records and may not be feasible or cost-effective. When the inventory items purchased or produced are identical and interchangeable, specific identification is not appropriate. In such circumstances, several assumptions about the flow of course, such as average, FIFO, or LIFO, may be appropriate for the measurement of periodic income. The method selected should be the one that, under the circumstances, most clearly reflects periodic income. Average method. The average method assumes that goods are distinguishable and are therefore measured at an average of the course incurred. The average may be calculated on the periodic basis or as each additional purchase occurs, perpetual basis. The moving average method is used under the perpetual inventory accounting system. It requires determination of a new weighted average inventory cost after each purchase. This cost is used for every sale until the next purchase. The weighted average method is used under the periodic inventory accounting system. The average cost is determined only at the end of the period. The weighted average cost per unit is used to determine the ending inventory and the cost of goods sold for the period. It is calculated as follows. Cost of beginning inventory. Add cost of purchases during the period. And we will divide for the total of units of beginning inventory and the number of units purchased during the period. First in, first out. FIFO. FIFO. This method assumes that the first goods purchased are the first sold. Any inventory consists of the latest purchases. Cost of goods sold includes the earliest goods purchased. Under the FIFO method, year-end inventory and cost of goods sold for the period are the same regardless of whether the perpetual or the periodic inventory account system is used. Last in, first out, LIFO. The LIFO method assumes the newest item of inventory are sold first. Thus, the items remaining in inventory are the oldest. Under the LIFO method, the perpetual and the periodic inventory accounting system may result in different values for the year-end inventory and cost of goods sold. Under the periodic inventory accounting system, the calculation of inventory and cost of goods sold are made at the end of the period. Under the perpetual inventory accounting system, cost of goods sold is calculated every time a sale occurs and consists of the most recent, the latest purchases. Retail inventory method. The retail inventory method is a very effective means of estimating inventory value. It is used for interim and annual financial reporting in accordance with GAAP, federal income tax purposes, verifying year-end inventory and cost of goods sold data as an analytical procedure by an independent auditor. Cost flow methods comparison. The cost flow model selected should be the one that most clearly reflects periodic income. In a time of rising prices, inflation, use of the LIFO method results in the lowest year-end inventory, the highest cost of goods sold, and the lowest gross profit. LIFO assumes that the oldest and therefore the lowest priced goods purchased are in year-end inventory, and that cost of goods sold consists of the latest and therefore the highest priced goods purchased. Advantages of FIFO. Any inventory approximates current replacement cost in terms of rising prices results in highest net income, often matches the physical flow of inventory.